I'm telling you the economy is showing resilience. I don't think most people buy into that. I don't think that's a consensus view. It's certainly not in the forecasting community that there's that, not in the conviction that we're talking about. It's not all good. There's plenty of things to worry about. But uh, it adds up to, I think, some pretty solid resilience. And you say there's this slowdown, um, and some people might on occasion get really worried about the slowdown. I think they're probably overreacting.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The real money in investing is made by those who perceive what the markets are likely to do tomorrow and then position themselves today to profit from that future action. Today's guest, Lakshman Achuthan, co-founded the Economic Cycle Research Institute specifically to identify these key turning points for investors. So, which key turning points are in play right now, and how can we best take advantage of them as investors? Well, let's find out. Lakshman, thanks so much for joining us today.
Thank you. It's really a pleasure to be speaking again.
Oh, gosh, well, thanks. It is always a pleasure and a privilege to have you return to the program, Lakshman. So thank you for doing so. Glad to hear that the weather in Manhattan is getting much more pleasant now. Look, I got a lot of questions for you about what's going on right now, but maybe just a few quick context-setting questions to start with. First is the question I always like to ask you when you come on. What's your current assessment of the global economy and financial markets?
They're two different things. Let's start there. Global economy is growing. The question is it accelerating or decelerating? I'd say broadly speaking, it's decelerating, although there's quite a bit of variation in underneath the hood there, with some regions really having quite a bit of resilience, and others cycling down a bit harder, I would say at this point. Um, that's on growth. On inflation, inflation, the pace of price increases has been decelerating for the most part all around the world for some time, having jerked up very strongly earlier. And that is also shifting. There are some places where the inflation cycle is actually troughing and starting to firm to the upside, and others where it kind of seems like it's just really cycling down hard, but it actually may be flattening out quite a bit. So that's a separate cycle in inflation from growth on the global economy that we're keeping a close eye on, just tracking where are we in those two cycles, because oftentimes they get conflated, but they have a lot of impact, and maybe how they get conflated has a lot of impact on financial markets. So financial markets, I think by and large, have been doing pretty well. Financial assets, for the most part, have been inflating. Um, and if you have them, if you happen to own them, that can be a good thing. Some of them, commodities are obviously a bit more volatile. They're kind of swing, they jerk to the upside down and then maybe firming again. Um, Home prices, a little bit of a mixed bag, but probably firming globally. And share prices, in many places up to the upside, and in particular, the one region of the world that really sets the tone for financial markets is the U.S. Economy and markets, which have been quite resilient and are really holding up. And now they have this beginning of a rate cutting cycle to support them a bit more. And I guess the one other nuance there, and then I'll take a breath, is that it's been a long time coming, but in Japan, there's a whiff of inflation, which has the Bank of Japan just very, very small amounts moving their interest rate up. And the actual the amount isn't the big deal. It's the fact that they're doing anything after such a long period of time, and so that may be in some ways interacting with the market, if for nothing else, just a little bit more incentive for a Japanese investor, and there's many of them, to keep a little money at home.
Okay. So you gave me a lot of fodder to
I
react
give you plenty to
to.
pick your poison. We can go
Yeah.
there.
Okay. All right. Well, just to make sure I heard you correctly, so you're all about cycles.
Yeah.
And in a moment, I'm just going to ask you to give the quick elevator summary of your cycles. I know you've given a longer description in the past, but for folks that haven't seen your previous interviews, I just want them to get a sense of kind of how you look at the world.
Hmm.
But you do look at it through cycles, and it seems like you're seeing the global economic cycle as I guess decelerating, but trajectory sort of starting to move down again. Where inflation, it seems like we've come down, and you're seeing a troughing. Maybe some parts of the world maybe beginning to kind of move up a little bit, but
Yep.
it's further ahead in the cycle. We'll say it's come down, it's troughed, and then TBD what happens next. Um, all right. So you were nodding as I was saying that, so I think I got that correctly. Um, so global economy, you said there's different parties have been doing different things here. I think the U.S. has been kind of the best player. It's been the sled dog that's kind of been pulling the global economy for a while. Europe uh, seems to just kind of be still pretty anemic. China was the place that everybody was hoping was going to return to growth this year, and it really disappointed expectations. But just very recently, they've announced, some pretty prodigious stimulus programs. Does that lead you to think that China will, but do you think that'll be successful in boosting China economic growth, or is that maybe a sign of desperation and weakness?
It could be both. It could be both, right? It's all about timing. So does their action change our view? Well, that's to be determined, right? So our view, and this gives a little context to the comments I'm making about cycles, is predicated, it's designed, it's derived from forward-looking leading indicators, which capture the key drivers of the cycle. And so the key piece of information that we're adding to the puzzle for decision makers is the wind at your face, or is the wind at your back? Is it switching direction within which other decisions can be made? But it's very important to know if there's been a directional change in where growth is headed or where inflation is headed. Um, so when people were very excited, this is ancient history. When China reopened, people were quite, after COVID, they were quite excited. This is it. We're off to the races,
Right.
the big economy, so on and so forth. And the markets got a little ahead of themselves. It didn't happen. So there was a bit of a lift in the markets, a reflex lift, and then it deflated again. And a little later on, these forward-looking indicators that I'm talking about today turned up. And so it was almost kind of like this false start. And then the equity leading indicator said, okay, let's go. We have a cyclical upturn. Time frame wise, I'm looking out just a couple of quarters. I'm not making some long-term bet here. This is a cyclical bet. It's a tactical kind of directional call. And we got that. We got a couple of quarters of upturn. China, for all of its efforts to become a kind of a fully integrated domestic economy driven by domestic activity, really needed to rely quite a lot on exports and the gearing of the global economy in order to get the growth that it had earlier over the past year or so. Now, with the global economy slowing, that portion of its economy is slipping. And so now you're left to look to the domestic economy for demand growth. And here we run into trouble. two big things to think about. One is the housing crisis never left. It's still there.
Hmm.
Okay. So they have gobs and gobs and gobs of extra housing, and it's very difficult to get anything to happen when you have so much supply of empty stuff. And so I don't know the answer to that, but it's there. It hasn't gone away. The second thing is uh, over the last several years, there's a I don't know how to exactly to describe it as ideological shift or whatever, but it's maybe less friendly for capitalist activities, you might say overall, and
Hmm.
so that has a bit of a chilling effect. And these two things, the housing problem, the real estate problem, and the debt associated with that, and just it's a little tough if you get going with some sort of business, how far can you go? Within that framework at the moment. And so those things I think are real big challenges. I don't see any short or near term resolution to that. So it's in the context of some cyclical slowing, which weighs on the exports, which was helping them quite a bit
Hmm.
earlier. Okay, so the cyclical wind is not at their back. They've got these other structural pieces, maybe the way that their economy is organized or managed or what rules or whatever you want to call it, and this huge overhang of housing and related debt. It doesn't seem that compelling at the moment. So in there, you have these initiatives announced. So sure, I think there's a knee-jerk reaction to be like, yeah, this is great. Okay, good. They're giving us some policy support. I have no doubt that's making an impact. It has in the last couple of days. It probably will continue to. There may be more to come, but I don't see. It's not immediately apparent how that's resolving those two big issues structurally, and it doesn't change the direction of the global cyclical slowdown. And so therefore, maybe you get a bounce, but I don't see anything particularly sustained at the moment. And so, does it matter all that they've done? If our forward-looking indicators get some purchase and start to have upward traction again, then I would say let's be more optimistic. But until I see that, I'd say, we don't have a good reason to take on risk there.
Okay, so right now you're not seeing it. You don't necessarily expect it for the reasons you mentioned, but obviously if you start seeing it, you'll change
Yeah,
your point of view.
yeah.
Can I ask you just a question that I've had a long time about China and its housing market? And forgive me if it's a naive question, but I'm guessing maybe some other folks are thinking the same thing, which is that China's sort of famous for overbuilding, right?
Mhm.
These famous ghost cities and things like that, and real estate became this asset class, almost like a bank account for many people, right? They didn't trust the money in Chinese banks as much. They trusted in real estate. So the people would buy these almost kind of sight unseen apartments or whatnot in some city somewhere, right? Um, Now the overbuilding is caught up with the system, and China's got this massive real estate bubble popping right now, as you've mentioned. To me, it's like, let's say there was a fervor for some sort of commodity, right?
Mhm.
Um, that commodity is going to have whatever intrinsic value it has today, it's likely to have tomorrow or a year from now or 10 years from now, right?
Mhm.
Whereas an apartment built in some Chinese city somewhere is a depreciating asset. And we've all famously seen issues with Chinese products and construction elsewhere in the world. Bad Chinese drywall here in the States from developers that are just rushing to get something built really cheaply, right? And you got to wonder, like, did that happen back there in China as well? Especially as there was a craze to build out these things, and did the developers cut corners? And if nobody's been living in a lot of these places, they haven't been being maintained probably. So does that sort of compound the problem there, where there's all this debt that's been taken out, around this build out, but the assets themselves are depreciating assets, and maybe like kind of depreciating on an accelerating basis for a lot of the factors I've mentioned. So you end up basically with all the debt without an intrinsic value left over at the end of the day, I guess, except for the land value.
And all of that is true. Even if everything was built great and great quality stuff over time, time is going to wear on this stuff if it's not used, as you said. I don't know what the answer is. They can take some of that supply off the market. I don't know what the policy mechanism is to do that, but that's kind of ultimately what you need to do. I mean, here in the States, when we had some problems decades ago, you had the Resolution Trust Company come in
Hmm.
and take over a lot of things. I mean, you might need to do something bigger, like different. We'll see. But if you keep pulling the same levers that they've been pulling over the last several years, I wouldn't expect, and maybe just doing it a little more, pulling them a little more.
Hmm.
It doesn't seem like a game changer. And so and it's interesting because the other so debt was one way to get growth and they're hardly alone. I'm not picking on China. Everybody around the world has used debt.
Well,
To,
China was kind of late to the game, right? I mean, they kind of pulled us out of the global financial crisis because they didn't have a lot of debt around then. Now they've caught up, right?
they totally caught up, but you're right. That's they were late to the game when you look over decades, and they've fully caught up here. Now the the issue is they'll probably do more debt, right? Because that's what they know how to do. That's what
Hmm.
pretty much all policymakers know how to do. You know, I'm not casting aspersions. That's just what they do.
No
And
argument for me on this one, Lakshman. I'm right with you.
and so you'll probably see some more of that, but I think you actually just need to drop that supply in order to actually, because it's a big problem, right? There's so much of it. So that's an issue. But the thing is, the other thing that they've always, so debt was one playbook to use as a policymaker. The other playbook, at least for the emerging markets in general, I'm not going to pick on China here, right? Is to export. And so you build up some capacity in something, and then you export it to the developed world. And you give all the consumers in the developed world a lower price. And we used to call it the China price
Hmm.
back in the day. And all the consumers in the West were happy for it, right? They say, "Hey, this is cheaper stuff. I'll take it. I'm saving some money." And now uh, the world is set up, and I'm not talking about current politics. This has already been in place for a while. The West is much more reticent to let a lot of supply from abroad come in and mess with its domestic producers. This is in Europe and in the US and other countries, right? So so that policy playbook has limits too. And so therefore I don't see an easy way out. Happy to play the reflex reaction to the upside because a policymaker says we're going to give a lot of stimulus, put a put under the market,
Hmm.
but um, it doesn't look like it's terribly persistent. In contrast, right? So that's like a huge problem with not a great solution, I think, in a way.
Hmm.
And we could spend a lot of time trying to think it through. But I would say, oh, what's really interesting is the US, right? Which is in a slowdown, has a whole different set of factors, under the hood. Um, it's not all good. There's plenty of things to worry about. But uh, it adds up to, I think, some pretty solid resilience. And when you're managing risk, and again, when we talk about cycles, wind at your face, wind at your back, that's kind of a risk management. That's how we think about risk, right?
Yeah.
And so, all right, maybe there is a really smart person who could figure out China and how to do it and how to play it. And I see the general contours and some issues, but I'm not sure how to really figure that out. But on the other hand, if you compare it to the US and you say there's this slowdown, um, and some people might on occasion get really worried about the slowdown, I think they're probably overreacting. And I think that's
Okay.
your place to play in a way with
All
your
right. And this is where I wanted to go. So thank you for taking the conversation where I was hoping to take it, which is, you sort of made a good argument that, look, China's not out of the woods, it seems like, at all, but the US has been surprisingly resilient. And you gave reference to the recent Fed policy pivot, which has now finally happened. And we've got the 50 basis point cut, which I think you said will be supportive of US activity. I kind of scribbled a note down here as you were saying that, saying, does that mean we've dodged a downturn? Right? There's been the whole debate over hard landing versus soft landing, no landing, et cetera. And a lot of people who do have concerns about the U.S. It's not a spotless shirt, right? It's still there in the dirty laundry hamper, but might just be looking better than a lot of the other shirts. Um, and a lot of those people have said, for a whole bunch of different reasons, there are shoes that should drop that eventually the U.S. is going to have to pay the piper for, but maybe not, because there are some that argue that it don't. So I'm curious what side you fall on. And let me just mention one other analogy that you can address or not in your answer, but like, um, we can imagine ships in a harbor and they're all sinking just at different rates, right? Some have more holes in them than others. Um, you can basically, point out that all these ships are sinking, but you have to make a choice. Which ship am I going to be on? And everyone's pretty much going to jump to the ship that has the fewest holes and is sinking the slowest. And what I'm taking from you is you think that's the US right now. But maybe not. Maybe you think we patched the holes and it's not going to sink at all. I don't know. I'd love to hear your answer.
yeah. The one thing I'd like to clarify is the rate cut doesn't necessarily change our outlook. That I have to see how that impacts in our forward-looking data. But I do surmise that the rate cut's probably supportive of markets, kind of.
Mm-hmm. Sure.
I think they're
Especially in
kind
the
of,
short term, right?
yeah.
Hey.
That's what I would say. So um the cycle has turned. Now I need to get in the weeds a tiny bit. It's not that complicated,
Please
but
do.
we have cycles in growth, accelerate, decelerate, but you're still growing.
Mm-hmm.
And then business cycles, where you have a business cycle downturn, that's like the dreaded R word. And
Yeah.
that's when you're not growing, you're actually contracting.
Yeah.
So one thing when you hear me say, if you hear me say, hey, resilience, something like that, okay, around growth, I'm saying, look, there's no hard landing here. We've got all the radars on, they're all functioning well, and the the opportunity for something to come along, even a negative shock, and cause a hard landing is very low. So in a risk management world, that's information.
Mm-hmm.
Okay. So we have a growth rate cycle downturn. Now in a deceleration, so it's slowing. Now I'm talking holistically about the whole economy. There's a
Mm-hmm.
lot of stuff going on underneath.
Sure.
Uh, and I do expect that manufacturing's got a little bit of traction here, but I don't think it could hang in that long if there's a global slowdown. So that might soften a little bit. But the services and the construction parts of our economy are actually hanging in. They're okay. And at the beginning of the year, there was definitely cyclical impulses to the downside, but they were being offset by structural things in our economy that were really holding it up. So we called it its tug of war
Mm-hmm.
between cyclical and structural. And the cyclical vulnerability um, manifested in a slowdown, but one that's pretty darn resilient. It's not like accelerating hard to the downside. And therefore, a window of vulnerability within which a negative shock is a problem, it's not opening up here. So, for example, if you think back a little bit in July and August, the markets got jittery. They went down a
Hmm.
bit. The R word popped right up. And given the construct I'm just describing, we could say, no, there's no hard landing because the window of vulnerability is shut. This is a market event. This too shall pass. It's probably not going to persist. And now we're back near record highs as far as I could tell, right? So
Yep.
so so that's how you use this in a kind of a risk management way. The structural components that are holding this economy up are worth noting because I think listeners will, depending where they sit and what they're looking at, either will say, I agree or I don't agree, right? And
Okay.
this is explainable.
So
It,
please let's dial through them. And a question I have that hopefully you can address in your answer is how much of this is due to fiscal stimulus?
I think a hunk of it is. I think you could draw a decent line between fiscal stimulus and non-residential construction activity, which had kind of a hockey stick up over a year ago and stuff, and drew in a lot of private capital for building of different kind of capacities, manufacturing capacities here.
Yeah.
And that's not over. Like it went to really bonkers growth rates and just settled down a little bit, but it's not disappearing.
Yeah.
That's ongoing. And I think that's a pretty clean, almost straight line. There's no straight lines, but almost straight line. And the other thing is that this occurs, that that piece of stimulus and other stimulus. Look, the excess stimulus post-COVID it's like it depends how you measure it, but it's 7-8 trillion bucks. It's a lot of money.
So
Right?
it's a lot of freaking
That's a
liquidity. Yeah.
lot of freaking money, right? So
Yeah.
this is going to have an impact, and it hits the really interesting thing is it hits a the labor market when it's had this structural downshift in supply. So you have a ton of stimulus hitting a relatively low supply, and you know the story on the labor markets and what
Hmm.
they've done. There's all these record numbers. So when you look at what's happening now in the labor market, I'm going to describe two moving pieces. Okay. There's the discretionary piece, which cycled down already a while ago. And it cycled down, and the hiring there really slowed down
Yeah.
quite a bit. And that's kind of bottomed out. And it seems to be like, if you look at a chart, it's kind of like that. All right. Now, then you have a non-discretionary hunk, which is huge in our economy, which is around healthcare and around education and maybe a little government. This is, so this doesn't get impacted very heavily by discretionary decisions, discretionary spending. And that growth rate of jobs there just went up to about, I think it's almost like 30-year highs and has been hanging out there for a few years. This is all part of a structural thing. And that's softened just a little bit. And that's why we're having our softer jobs growth nowadays, is
Okay.
because we're coming off of these like 3-decade highs in that sector. So it all adds up to a label that we've been talking about for a long time, but I'll say it again, is labor hoarding. Labor hoarding, meaning um, even if things soften up, I'm very hesitant to fire you.
Right. Yeah.
Basically what it is.
Yeah,
Uh,
we've talked about this a lot in this program, so I think the viewers are familiar with this.
you're
Generals
familiar with
always fight the last war. Companies laid off a ton of people during COVID, and then all of a sudden had to scramble to hire them back, and it was really painful for them and hard, and so they don't want to let people go this time around if they don't have to. Yeah.
Yeah, so you'll do every single thing you can do except fire someone, right? So you'll stop the hiring, okay? But stopping hiring, slowing hiring, and that's what you see in the data, that doesn't make a hard landing, right? You need firings, like big sustained firings to start to weaken up consumption demand, which will contribute to a window of vulnerability within which you can have a recession. And that's not happening, at least as far as we can see, right? It doesn't seem to be
Okay.
haven't.
Some
And
might say yet, and I'm gonna throw a couple of stats your way in a second. But because your job is to look out, your headlights go out a couple quarters.
yeah,
What I hear you saying is according to my headlights, I'm not seeing anything a couple of quarters out that's got me worried about the labor market.
not in a aggregate sense. No, I mean, I think we could pick on something here and there, but not in an aggregate sense for the overall labor market. And when you look at consumption, and I'm sure you've talked about this too, the K-shaped recovery.
Absolutely.
Um, right. So the lion's share of people are working check to check. They're working for a salary, a wage, or whatnot, and then spending that to live on. And they are not that happy right now. It's not a great situation because the prices are going up and the wages are going up a little, but you know how that game is, right? It
Yeah.
doesn't, at the end, it's tight. And that's the vast majority of people. But a significant fraction of people have assets, and those assets have inflated a lot. And they actually do the most of the consumption. So when you add the whole thing up to demand, consumer demand, personal consumption expenditures, these kind of things, they're holding up, they're not collapsing.
Okay. Yeah, I talk about this a lot, which is it's really important to understand the difference between mean and median, right? And on the median level, I think you can point to data and say that the median consumer is having a rough time that might be getting worse, where the short end of the K, where all the money is keeping the mean, the average, still pretty doing okay.
Yep.
But let me just throw a couple of things for you to react to on this, because I talk about employment a lot, because it's such an important bulwark between the economy and recession. Um, so first off, I think we've all probably seen the same parade of consumer companies, big brands that have come out and basically given disappointing forecasts, citing weakening consumer demand. Um, that is not limited to just the mainstream consumer brands. Luxury brands have had their issues too, right? So some people have pointed to say, hey, it looks like the higher end is beginning to soften as well, which would be an indicator that the short end of the K, where all the money is, might be running out of steam here as well. Let me just mention this other point to you, and I know you mentioned that hirings aren't everything. But layoffs soared in August, hitting their highest total in 15 years, while year-to-date hiring hit the lowest in 19 years. And this is all according to a survey by Challenger, Gray, and Christmas. So there's other data that we could point to, but I just mentioned those to say, I think I understand why some people will say, well, I see some storm clouds in the labor market. And of course, we had the massive payrolls revision. So kind of two questions for you. What's your answer to people who cite data like that? And maybe your answer just might be, hey, those are only a few data points and the majority are more supportive, whatever. But also given the revisions that we had in the BLS data, which many people for a year plus leading up had been saying the BLS data seemed to have a lot of warts in it. How confident are you in the data that you guys at Equity are using around the employment market? How much confidence do you have in that data? You know, how much of that is government data that may still have a lot of warts on it?
Okay. So one thing is, what about this data that's showing the weakness? And the other is how confident in the data itself. And
Yeah.
so on the data that's showing the weakness, 100%. It's complete. I actually find that completely consistent with a growth rate cycle slowdown. So when I say a growth rate cycle slowdown, what I mean is that the coincident data that describes the economy outside your window
Mm-hmm.
is output, employment, all these measures, all these coincident measures of employment, not one. They can all go in the mix
Yeah.
together because they're all imperfect.
You're measuring the level of the soup,
Yeah,
whatever's in it.
but the big hunks, really, you don't have to be an economist. It's just like output and people working. Okay.
Yeah.
Those are two big, huge things that tell me where I am right now in the economy. And then I supplement that with income, how much is in my pocket and how much can I buy? What am I buying? So these
Yep.
are all my coincident data. All of that stuff together is decelerating.
Yep.
Okay. So when you say, or when someone says, "Hey, there's this job stuff and it's getting weaker," 100%. Yes, we're in a growth rate cycle slowdown. I agree. We are aligned. The question is, what does it mean? Does it mean that we're falling off the cliff? Is something
Right. Right.
bad going to happen?
How bad will it get? Yep.
Yeah, or did I just, did I just decelerate a little here? Is it a pause that refreshes? I don't know on that score yet. But did I just decelerate or am I about to hit something? And what I'm saying is we're not going to hit something here,
Right. At least in the next couple of quarters, as you can
at
see.
least in the next, couple of quarters, right? We can't see that far, but right now, I know I mean, the whole design of all the narratives and the headlines is to be pretty alarmist. But right now, I'm not that alarmist. I see some resilience in the United States with the forward data, even as we are decelerating. Now, in the data, this is an interesting question. How good is the data, right?
Mhm.
It's like, what do you know? What don't you know? And all these things, like, and what you don't know, you don't know. All these things that we got to contend with when we're trying to figure out what to do. And we all want precision. It would be nice to know, but the truth is we don't, right? We can make efforts. We can and all these models and these measures and these surveys are, darn good efforts to try and 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 say we know something. But it's actually not true, right? You don't really know. So we have a price. There's three kinds of data that I look at that ECRI is looking at in its framework. You have a price. That's a real thing. You can go out and buy a cup of coffee, and there's a price, and you get the cup of coffee.
Yep.
That's a real thing. That's about as real as it gets. You can have a survey like Challenger you just mentioned. That's where you call up a bunch of people and you ask them a question and they tell you something. Now you know how that is, right? Someone tells you something and yeah, maybe it might be aspirational, it might be fears, who knows, right? But it's a person talking to you,
Yeah.
right? So that's what we call soft data. And then you have something called hard data, where the government, mostly in the work we're doing, national governments are counting things, right? They're counting output. They're counting sales. They're trying to go out and count things, and they do the preliminary numbers are through surveys, and then slowly they might actually go and count it, which is where you get this big dispersion between these monthly payrolls and what the QCW gives you a year
Yep.
later when they've counted everything and you got to reconcile it. Okay. So I don't think there's anything quite nefarious going on there. It's just the nature of counting stuff and statistics. It's hard. You want to know right away, but you can't actually know right away because you got to count it. It takes a long time to count it or to get the information.
Right. And sorry, just to
Yeah.
put here, there have been some big distortions in the system. Um, like COVID blew up basically the economic models because we laid off so many people and then we scrambled to hire them back on. And that has a bullwhip effect that ripples through for quarters or actually kind of years. And I've talked to people who work closely with the BLS who have said, yeah, a lot of the folks at the BLS have kind of admitted, yeah, our models aren't as good as they usually are because we're still having the echo effects of all that go through.
Yeah, they've got in the estimates, they've got these seasonal adjustments. And so if you close the economy in March of 2020 and millions of people are out of work, that actually automatically goes into a seasonal adjustment that says, oh, that always happens in March, so therefore we have to add it all back. And
Yeah.
it's just now you're just playing with numbers, right?
Yeah.
So all of that is true. I don't think it's particularly nefarious. It's just the way it is. When we go internationally, some countries count things differently.
Right.
Some people are less eager to give data. I mean, all kinds of problems happen out there with data. Okay, this is all the nature of the beast. So what do we do? If you're putting together a model and you're saying this plus that plus this times something equals my output, it's not very forgiving when the data mess is weird. Like if the data's weird, your output's weird.
Hmm.
I'm going to oversimplify a bit, but we just don't do that. We're not additive. I don't get to an inflation outlook. Yeah, we'll talk about inflation in a minute. Inflation is turning up in Europe and it's kind of sticky in the US and, not falling fast. And when we're making those forecasts, it's not because we're adding up, the housing estimate plus the used car price plus the oil price and getting some forecast of inflation. That's not how we do it. We're looking at the drivers of the cycle, things that turn before turning points in the target, in this case, inflation. And we're looking at the directional move. So let's say a number is whatever estimated at 10, but it's really 5. Okay, so that's way off. It's not a good measure. But as long as that bias and the mistake directionally is consistent, I have what I need for the directional call.
Right. Whether it's 5 or whether it's 10, if it's accelerating,
Yeah,
you know which way the wind is blowing. Yeah.
inflection. And so then we know, again, going back to risk management and decision making, am I looking that way or am I looking that way? And even with flawed data, we can get a good read. And this becomes very important when you look internationally. And so that's the kind of directional stuff that we're bringing to the decision-making process, for an investor, for a business manager. They'll have all their models and stuff, but if you get a directional signal going one way or another, you really have to put a pause. You can't blindly follow the model.
Got it. Okay. Well, look, I feel like I've been throwing a lot of specific questions in here that's been slowing our progress to get to the thing that the viewers want most, which is the so what, right? So, okay, Lakshman, what does this all mean for us as investors? Where in these cycles, should we be looking for the puck to head from an investing standpoint? So let's try to get there, but of course, let's get there through inflation because that's very important. Um, uh, you mentioned that it sounds like inflation, may be troughing globally right now. In the US, I think we're all still sort of watching the egg in the pot and trying to figure out, is the water going to boil soon? Is the Fed going to achieve its 2% goal? And it's pretty close. I mean, just to give it credit, we're not that far away. We're, depending on what metric you look at, we're either the 2 handle or a 3 handle. What are your inflation cycle indicators telling you?
Not different, 2 and 3. It's a big difference in terms
It
of
is, but it's not a 5 or a 9 like
no,
we've dealt with recently.
I'm
Yeah.
just I'm messing with you a little bit. But so the future inflation gauge is what we use to anticipate the direction of the inflation cycle. And, I kind of wish it's all water under the bridge that they'd looked at it in 2020. But that's another
Yeah.
podcast interview. Now here we are. We've got an inflation cycle downturn. That's all real. There's nothing. It's for real. There is a nice solid downturn in inflation. But the forward-looking data, which anticipated that, has been going sideways. It's not going down. And in fact, it's been going sideways for a while and has drifted a little bit toward the upper end of the band it's been in for many, many months. And so when you say, or when someone says, hey, we're going to go down to some specific target and hang out there, the data kind of challenges that.
Tells you not to be that confident. Yeah.
Yeah. And even forget about the future inflation gauge for a minute. I don't even step back from the current cycle. If you look at inflation, it doesn't do that. Inflation doesn't go somewhere and hang out.
Mhm.
It cycles. It cycles up and it cycles down. So we're in a down cycle. I don't think anyone, I'm not disputing that. No, I don't think anyone else is. Um, but is it going to go down and hang out there? I don't think so. It's just not the nature of the beast. So I'm watching the future inflation gauge, and this is an if. I don't have this. I don't know that it'll do this, but if it moves up, that's a really big deal. Now, if you're the Fed and you're trying to figure out what to do, and you're managing your risks, and you're aware of what I just said, which I'm not fully sure the current Fed is, then yeah, I'd be getting the cuts done now. Get it while you can. Because again, the nature of the beast is it's cyclical. So it's going to turn at some point, and I'd much rather have gotten my cuts done before it turns than having to cut as it's turning. We're here at the end of September, and I know some people were taking it a little easier in the summer, I hope. But there was a ECB hike where very inconveniently inflation went up when they were hiking, like maybe the day before or something, unexpectedly. And so they ended up describing it as a hawkish cut, which seems a little tortured, you know,
Yes.
whatever, jawboning.
Tortured logic. Yeah.
Tortured jawboning. So I would, from a cyclical point of view, you've got a growth rate cycle slowdown, you've got an inflation cycle downturn. Uh, the growth rate cycle slowdown is actually resilient. It's not tanking. Uh, but if people are worried about it and inflation's coming down, you might as well take the rate cuts while you can, because things will change. This too shall change. Either maybe the economy gets a little stronger and it's tougher to cut, or maybe the future inflation gauge goes up and it's tougher to cut. I can't predict the predictors, but I'm watching for that kind of stuff. When you look abroad, this is again why I say the U.S. is a relatively easy bet for the time being on a tactical sense. If you look in Europe, they've got a slowdown. It's less resilient.
Right.
Okay, so that makes me hesitate a tiny bit there. And then their future inflation gauges actually have turned up. They're not just flat, they've turned up. And so the incoming data, when you get your CPIs or whatever the coincident measures are, you tend to see them a little higher than expected. In particular, if you look at core, because what's been helping inflation, the headline numbers in the last couple of months has been oil has gone down. But if you get in there to some of the core pieces of what makes up inflation, it's not the same picture. It's a
Yep.
more difficult picture.
Um, okay, so a couple things here. So obviously, looking at all your indicators, to my earlier analogy, Europe, that boat has more holes than the U.S. boat does. So if you're going to play in one, you're looking for relative safety, you're going to jump in the U.S. boat. To your point about where the U.S. inflation cycle is, um, two questions for you. Does cutting rates in this environment accelerate the cycle? Right. In other words, are Fed rate cuts more likely to bring us faster to an upturn in inflation if we are indeed troughing?
Yeah, so when you get to the drivers of the cycles, and in very different ways for growth than inflation, the cost of money is a component of that. So it's not a literal input, but it's going to impact things that are going into our forward-looking indicators. And so uh, cheaper money in theory is going to stimulate demand, and that's going to manifest uh, with a lag in the forward-looking data. The markets, there's no lag, right?
Right.
So you cut rates half a point, and the markets immediately are like, oh, all these things are worth more, right? Because they're doing a knee-jerk quick reaction. But in order for that to actually manifest in the purchase of an apartment, right, that takes a while.
Right.
And then, the whole reason that this kind of cost of money even moves the business cycle is you purchase an apartment, a house, something like that. Then you start to do some work on it and furnish it. All that takes time to propagate through the real economy. So something like that may show up in some of these forward-looking indicators along with other drivers and impact things down the road on the real economy. On the financial markets, it could happen almost instantaneously.
Yep. Okay, you just gave me another question to shoehorn in
I'm
here.
sorry.
No, because you mentioned a point I talk about an awful lot, which is the lag effect.
Yeah.
I still have another question I'm getting to on this, but uh, so yeah, the impact of this recent Fed cut, we're not going to really see in the economy for a while, quarters, maybe a year from now, right? Maybe a year plus. Um, there are people out there, and I will admit I am one of them, that have said the lag effects from the higher interest rates that we have had are still traveling through time towards us and
Mhm.
will continue hitting the economy for some time from here. Sounds like you're not that worried, though, about them dragging economic activity and inflation down much as they continue to hit over the next couple quarters, given what the leading indicators are telling you now. True?
Correct. Yeah, leading indicators, I mean, if we oversimplified and this is not true, but if we said all it was that, then the fact that they're resilient suggests there's not a huge hit coming from the lagged impact of the earlier rate hikes. People have pointed out, and I haven't done this work, but it sounds plausible to me that there's a wall of financing sitting right in front of us
Hmm.
that was of like real estate type financing, CRE,
Absolutely. Yep.
that is breathing a sigh of relief that you got the half point because that was coming due fairly soon.
Hmm.
And so that took a little of the sting off
Right.
of
And
that.
some would say a little, there's still a lot to go. There's a lot of
Plenty
sting
to
left
go.
if they start re-rating. Yeah.
No, no, no. The medicine was substantial of the earlier hike, but it's just a little less with the
Yeah.
half point. And as I said, if I were them, I'd do, now's the time to say, mission accomplished, we did it. Pat yourself on the back. Because the cycle by their nature, they go like this, right? So they don't go down and stay there. And that, therefore, if we have a cycle downturn in inflation, I don't expect it to stay there. It's probably going to go like this, especially if you've got a tight labor market and you're stimulating the economy.
Right. Well, let me ask you this then. So you said, hey, if you were to think that inflation was going to start turning up again, we'll get your cuts in now because you basically have a little bit more slack to hike again. But to the point you just made there, like, why not just stay higher for longer? Maybe even hike. Get ahead of this, especially because Powell, presumably, from what he said, doesn't want to be an Arthur Burns. He wants to be a Volcker. Um, he doesn't want to have inflation pick back up in 2 or 3 quarters here because it'll look like he didn't get the job done, right? So why even play around with rate cuts and try to be kind of cute about this? Why not just keep it high and really try to kill that inflation dragon, especially when the economy is showing resilience and the job market is okay, right? That's the time where you can take harder measures.
Right. I'm telling you the economy is showing resilience. I don't think most people buy into that. I don't think that's a consensus view. It's certainly not in the forecasting community that there's that, not in the conviction that we're talking about. So when you see a growth rate cycle slow down and you see an inflation cycle slow down, and your policy framework is to not use forward-looking models. We don't use forward-looking models either, but to just abandon that and rather look at coincident or even backward data in your policy. It's very hard to be preemptive and to say, I want to keep things high, even though I see growth slowing. right? It's only if you were looking at indicators that were forward-looking, saying there was resilience in the economy, that you would be confident at leaving rates high.
Right. So just to reword your words and correct me if this is wrong, but if Lakshman Achuthan was running the Fed right now, he probably would have stayed or hiked rates and not gone into this cutting regime.
I would have hiked rates. No, that'll blow everybody's mind. I would have hiked rates back at the end of 2020.
Okay.
I wouldn't have done it like this because
Right.
a stitch in time saves nine. But that is not what we're talking about. We're talking about a reactive policy,
Mhm.
which is moving after inflation moved. And that's the world we live in. And what we have right now, if you look around the world, pretty much all central banks are trying to cut rates. Japan's the only one that's like, maybe we got to edge it a little bit.
Yeah.
The other ones are trying to cut. Bank of England's having a little tough time, right? Because the inflation's popping there. Europe, we'll see, but I suspect they'll have tough times too. But they all want to cut. This is the cutting time because they've got the slowdown and because they have the inflation cycle downturn in their backward-looking data.
Mhm.
And we can talk here about forward-looking cyclical indicators. I got to tell you, that's not mainstream stuff. That's not where central banks operate. They're using these big econometric models.
Right. And notoriously are criticized by driving by looking in the rearview mirror. So they're almost by definition not looking forward.
Yeah, well, it's just, I mean, there's probably all kinds of things that are impacting their decision-making process and whatever, but it's certainly not what we're talking about here. But what you can do is know that regardless of what they're doing, you're not in the room, I'm not in the room with them, right?
Mhm.
But I can kind of know, I know something, and we're discussing something about the direction of growth and inflation, the risks of that looking forward. And regardless of what they're doing in the room, that's going to impact them. And so I know that if the future inflation gauge moves to the upside, I don't have to be in the room. I know they're going to have to react to that. It hasn't happened yet, so we're watching for it.
Right.
I do see it happening in Europe and in the UK. Those future inflation gauges moved, and you're seeing, regardless of what they say, they didn't cut rates in at the Bank of England, and the ECB is going to probably cut, but it's going to get uncomfortable.
Okay, and to a certain extent, it sounds like, your confidence in what's going to happen in the US will grow as you see if this plays out according to the script you think it will in Europe, it'll give you more confidence that it'll happen here when our central planners get put in the same corner. Okay, so now we're at the so what part of this. So Lakshman, one, I very much appreciate this conversation because it is in some cases different than a lot of other analysts that have had on the program here. I think you are more optimistic about the economy's prospects than the average person that I interview here. And your position on lag effects, I think, is a little bit different too, which is all great. And this is what makes a market, right? Is different people's perspectives. So you see that U.S. economy is going to remain pretty resilient from here. Think we're going to avoid any sort of hard landing or recession, at least in the next couple of quarters. You think the rest of the world is going to look worse compared to the U.S. And you think that inflation globally is going to start to creep back up, eventually even so here in the U.S. So that's not necessarily what the markets are thinking. They're currently having their party that the Fed just pivoted and they're getting rate cuts, and we've seen the sugar high boost from that. So if you are looking to allocate capital from here, how would you be considering that given these principal factors of your outlook?
I'd be more risk on when people get scared about a hard landing anywhere around here. We did that in the summer, and I would continue to do that. Um, One other spot in the world that's pretty good is India, by the way,
Right. They're crushing it. Yeah.
structurally and cyclically, both, but that's another story too. Um, and I wouldn't be surprised if we have a higher low in the inflation cycle. Uh, so inflation cycles like this over many, many years.
Hmm.
We're in this downturn. I think we're sniffing out bottoms, troughs in these cycles, depending on where you are. And I think in retrospect, when we look back, the the trough in this cycle is probably going to be higher than the earlier trough.
Got
Uh,
it. Yeah.
and
Well,
so
the old trough was
pretty bad.
ZERP, right?
Well, sure, but it was below two as well down there. And if that's the case, you kind of want to be in something that's going to inflate.
Hmm.
And so now you have to decide which ones.
Okay.
Which ones are you which ones
Stocks
are
and commodities come to mind right away,
the
right?
stocks and commodities come to mind. I think there's when there's slowdowns, there's the policy response. You were talking about China. Uh, Basically, all policymakers at some point end up with more debt. It can either be out of the central banks they're doing things, or out of the treasuries they're doing things. And so that, in the context of higher lows in your inflation cycle, you want to inflate, you want to protect against inflation, those inflation hedges. So commodities, maybe even precious metals. You've seen gold has been doing quite well for longer than people thought it would, right?
Hmm.
Um, but in the least dirty shirt category, I think for the time being, the U.S. is the shirt you're putting on. It continues to be. It doesn't mean that we're not looking globally all the time. We cover 22 economies. That's why I flagged India for you.
Right. Yep.
But I think when you're allocating, if you're responsible for allocating large hunks of money, um, the bulk of it's got to be in inflating in the U.S.
All right. So fan of U.S. stocks primarily. There are some areas of opportunity out there in the world, like India, that one should look at too. Commodities, precious metals should do well in this type of environment. I'm going to assume in general that your view on bonds is not as rosy in this environment.
Not as rosy, not on a tactical basis. Uh, I want to clarify on commodities. So far, so good. Industrial commodities, but those may be topping out after this little pop that we're getting off of China. Um, and the thing about the indicators, right? So I'm giving you a snapshot of what they're showing risk-wise in the next couple quarters.
Hmm.
Um, and if someone's worried about a hard landing and wants to sell you their stuff, you could take it because that would probably be a good bet today. That can change. If the indicators, they can accelerate or decelerate from here, and that would change my posture. If they decelerated, I could work myself into bonds pretty quickly, but that's not today.
Got it. So first of all, two things. One, thank you for being so detailed and going through the list of what you look at here. It's at the end of the day, it's mostly why people watch this stuff is they want to crawl in the heads of smart people like you and see what they're thinking about potential investing strategies. But Lakshman, I hope you know this, but you have an open invitation to come back on this channel anytime that your indicators change and you want to let the world know about it. Please use this platform to amplify, your efforts of letting the world know.
Will do, will do. I appreciate being able to do that. Thank you.
Oh gosh, well look, I'm looking at the time here. We've just gone over the hour, so I've turned me into a liar saying I'd get you out of here in an hour, Lakshman, but I appreciate you staying a little bit late. Um, for folks that have really enjoyed this discussion and would like to follow you and your work between now and the next time you come on this channel, where should they go?
You have options. You've got options. we've a good place is on LinkedIn if you uh, follow Economic Cycle Research Institute. There's a newsletter, so it'll just pop out once or twice a month saying, here's a little shift in the outlook or something interesting. We like to see divergences when we diverge from the consensus view, so we'll flag those for you. Um, on our website, there's something called The Column, where we write about cycle issues. They might be a little more evergreen, but they help you understand the framework of how the cycle information can fit into your thinking, your decision-making process. And then this is somewhat new, but there's a YouTube channel being built out, and there's Economic Cycle Research Institute YouTube channel, and that's being built out, and that has like short instructional videos on Italian inflation or the ECB or India, something like that.
All right, fantastic. So, folks, highly recommend you make yourself available to every and all of those options. Lakshman, when I edit this, I'll put up the URLs to those here on the screen so folks know exactly where to go. Folks, I'll have links to all those in the description below this video as well, so you can get there with one click. Can't thank you enough, Lakshman. Real quick, just in wrapping up, is there anything that I didn't ask you about that you think is worth putting on folks' radar here before we wrap up?
Um, yeah, I guess the last thing I'd say is like, look, I'm describing cycles, but I definitely feel what's going on in the economy. I'm not blind to it. And when we talk about the K-shaped economy, I'm saying it kind of just to be informative and to make sense out of contradictions that everybody is experiencing. But it's very real. I think the majority of households and consumers are under a lot of pressure, and I don't want to be glib about that at all. I recognize it. I see it. I'm just saying there's not a hard landing here, and that's by dint of the way our economy works.
All right, and I noted when you were talking about the K-shaped recovery earlier, that I wanted to talk with you more about it because I sense it's something you care about from a social standpoint, and it's something that I very much do, and I talk a lot about on this channel. So we didn't have time to squeeze it in to this conversation because it really deserves, some real space to do it well. So I'll make a note so that the next time you come on, Lakshman, I protect some real time where we can really delve into that. Because I imagine you would say, uh, a lot of these trends that we have right now, socioeconomically, where more and more people are kind of feeling priced out of the middle class lifestyle. People are losing hope in the American dream. They kind of feel like the social contract is fraying, if not already broken. That just nothing good comes out of that.
No, and I actually count myself lucky in the sense that I've kind of been on both sides of the K. Right now, I'm on probably, I would say, on the upper side of it. I have some assets and things like that. So in a sense, I'm okay in that sense, but it doesn't mean that I don't know
Hmm.
what's actually happening. I do. And it's not really right. There was it Harding? Is back like pre-depression?
President Harding, we talking about?
Yeah. And so I'm reading the book of someone I know closely, and Harding is here at Cooper Union in New York, and he's talking. He's on the campaign trail, and he says, someone in the audience yells out, hey, I'm a family guy. I'm an able-bodied man. I want to work, and I can't. And Harding's like, God help you. I don't know what to do. And it spurred this person who heard this in real life to be like, well, that's not right. We need a better answer than that. And really got into trying to think about systems and policies that would provide jobs. And I know we're in an election year and everybody says blah blah blah. They're trying to give jobs, but underneath all that rhetoric is the way stuff works and understanding that, yeah, you see consumption or consumer whatever sales or whatever went up. What does that mean? Well, it means 60, 70% of the people barely bought what they needed to survive. And a bunch of other people got a lot of other stuff. And when you add it all up, we grew 2%. And that's not doing service to the majority of people in describing it.
Right, exactly. We're back to my thing about the mean and the median. You can
Yeah.
look at the averages and say everything's fine, but when you look at the majority of people, you can say, oh, it really isn't.
But
Yeah.
we should do, I'd be happy to do that at some point.
All right. I appreciate that. Like I said, I will preserve that space next time. So if if you're willing, we can really get into it.
I'm happy to do it. Happy to do it.
All right. Well, Lakshman, such a pleasure. Thanks so much for
Thank you.
coming on.
Yeah, you too.
All right. Well, now's the time of the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money, to both react to key points that Lakshman made, but also give us an update on what they've seen in the markets over the past week. In fact, it might be the past 2 weeks because they were not on last week, and John Lodra is away this week. So today I'm joined just by lead partner Mike Preston, who's flying solo. Mike, how you doing?
Very good, Adam. Good to be here. And I'll do my best, even though I'm solo. Thanks.
No, I've got full confidence in you, my friend. So what key takeaways did you take from the discussion with Lakshman? And then I want to talk about the Fed's recent 50 basis point rate cut to get New Harbor's point of view on that. And I also do want to talk about the precious metals with you because they have been experiencing a very impressive price updraft since we last saw you guys on the channel.
Yeah, I'll get to the gold and silver and the mining stocks a little bit later. They've had some really impressive moves. We don't think they're over yet. There's a little foreshadowing for you. But first, let's talk about what Lakshman talked about. Hopefully I said that correctly. Lakshman talked a lot about the economic angle. In fact, obviously his firm that he founded is the Economic Cycle Research Institute, ECRI. So the focus is on the economic data. And I can't pretend to be an economist, more of a tactician, or market tactician, more of a technician. We certainly are aware of economic cycles and economic data. A lot of what we do, though, is really look at charts and relative strength and things like that. So it was really interesting to hear Lakshman and hear a lot of the data that he looks at. These data are not things that we're completely unfamiliar with, but he certainly spends a lot more time with them than we do. So I thought his insight was really valuable. When you asked him the question, you always ask him about the global picture, the economy and markets. He said that the global economy is decelerating, and that inflation is decelerating, although he thinks it might be troughing. And so he said later on in the conversation, the thing about inflation is it doesn't hang around in a certain place. It's either going down or it's going up. And I think that I, by and large, agree with that. And I think that he and we see things the same way right now, that inflation is trending down, but might be hitting a trough. And he's certainly concerned about inflation increasing down the road. We are certainly concerned about that as well. We may have a mismatch in our expectations about when we think that might happen. For example, I think that inflation will be will go much higher in the years down the road, and perhaps potentially 2+ years from now, as central banks freak out in response to an economic accident. And I don't really think that Lakshman at the present time thinks that we're going to have a big economic accident. I don't think that central banks are going to freak out yet. In fact, Lakshman believes that there's a soft landing or no landing scenario. We don't really see things the same way. We see perhaps another bubble continuation, maybe another spike up in the market, followed by a collapse. I really think the market's going to collapse. And Lakshman points out that he's not really forecasting more than a couple quarters out. So I'll definitely point that out, that he says, look, I'll change my mind if the data changes. But right now, I'm not seeing any of this data that says we're going to have a hard landing or even a crash. And we don't know the future with certainty either. It's just that I've studied a lot of history. We look at cycles. I don't really think there's any other way that this amount of excess is unwound without some kind of accident. But there's a good amount of guesswork involved in that, and I'll be the first to say.
Mm-hmm. And by the way, that's specifically why I asked him, for those that have been, and I include myself in this bucket, warning about the lag effect of how high interest rates have been for so long. Do you expect more shoes to drop from that lag effect? And he basically said, I mean, I understand the logic of it, but looking at my forward indicators, I don't really expect it. So that is definitely a different opinion than many, not all, but many of the people that have been on this channel recently.
And I absolutely give him credit. Like I just admitted that there's some amount of guesswork involved in predicting the end of a cycle. Certainly a cycle as long as this one has been, really 40 plus years since 1982 or so when we took off in this bull run. It's really that big. I'm becoming convinced that this is really perhaps the end of that whole cycle. So it's really impossible to predict that end, although what I've studied my entire career in life leads me to believe that that's what's coming. He does, I think, the correct mathematical thing and looks at the data and doesn't try to guess. That's not to say that there's not some room for hunches in this business, because there is, right? So we base what we do on data, but at the end of the day, we're making a choice and a decision about how much exposure to take based on the backdrop of the fundamentals. In this market, the fundamentals are extreme, and they have been for more than 10 years. There's no way around that. And so we're happy to say that, you know, we're participating in the market. We've got our hedges, but we're not fully in it. I think that a lot of people out there that manage money, either for themselves or for hedge funds or whatnot, really kind of have to be all in or all out, because they get measured against the benchmarks and they get penalized for not keeping track with them. And we're very vocal about saying that, hey, we're 40% in stocks, and if we trail further up in this bubble, that's okay with us, and it's okay with most of our clients because we have a shared viewpoint. But, you know, Lakshman is ultimately correct in saying he's not seeing the data yet that tells him an impending turn is here. And I respect that. So Lakshman, I won't go too much more into more detail, but he talked about China. You asked him about the stimulus. I was shocked when I looked at China yesterday and I saw it was up more than 6%. So obviously China is doing some new stimulus programs. Is it going to be a
Just to let
long-term
folks know,
positive?
their stock market popped 6%. It was a massive gain day. But that's after their stock market has just been taken out to the woodshed and beaten repeatedly for the past several quarters. So yes, it's a 6% pop, but it's off a much lower number than it was, you know, a year ago.
It's been an underperformer for a while. In fact, it's been out of our model for a while. And we saw that pop and we started to say, well, geez, do we have to consider it again? It's something that we will consider. We're not going to do anything quickly. We're going to look at the data and see, does this really mean anything? And as Lakshman pointed out, you know, this is in a context of a cyclical slowing that they've got going on there. They've got housing related debt. They've got a lot of different problems. They don't have the wind at their back, so to speak. And the US does at this point. And I have to agree with them there that at least short term, the US has the wind at their back. Long term, I think the fundamentals of some emerging markets are better. That's why they're in our model. But China is still out of our model and probably will be for a while. We'll see. We'll see if there's a kind of seismic shift here. But I tend to agree with Lakshman. It's probably a knee-jerk reaction.
Got it. Hey, before you move on from China, I just want to note that I did an interview last week with Jesse Felder, who talked about a lot of the same issues with China and did make the distinction that, you know, price is what you pay and value is what you get. And eventually, sometimes, you know, a really beat up company, which still may have some real problems, may still be a good value if the price just gets beaten up to like the blood in the streets, left for dead levels. And he was postulating that that might be beginning to happen with Chinese equities. And that was before this pop that we're talking about. And presumably, Chinese equities will be supported, at least in the near term, if China continues to roll out additional stimulus programs. So anyways, if you're interested in learning more about that, go check out that interview with Jesse Felder. Sorry, Mike, back to you.
Yeah, absolutely. It's a good point. I mean, you know, all of China was certainly starting to look like a value proposition. And the thing about value, though, is that it's very difficult to catch a falling knife. And it's a lot of times it's easier to wait for some kind of pop and for things to change. And now I think that a lot of money managers are looking at China and saying, is this the pop that changes things? Because now the downtrend has been broken. We popped to the upside. We will probably wait for it to base out and see if we have further strength. But if you're absolutely correct that buying a value stock is more forgiving usually, but sometimes it can be very difficult to have patience and to keep that mental discipline, because I'm telling you from experience, but you'll almost always see that stock or that index go lower before you see the ultimate turn.
Yeah,
And those turns can be
absolutely.
violent when they happen.
Yeah, and by the way, Jesse wasn't necessarily calling that the bottom was in. Obviously, Lakshman thinks China's going to have a lot more issues. And all my point is just even a hated company can become a good value if the price gets low enough, and that may be happening in China. I also
Absolutely.
want to note too, Lakshman, you mentioned that Lakshman said India, and I know you guys have a few emerging market countries in your portfolio. I know that Jan van Eck, who spoke at your New Harbor event that you guys had in Southern California a few months back, super big on India. So it seems like Lakshman's seeing with the same eyes. And just to note for folks, Jan van Eck's going to be a guest on this channel next week. So we're going to get an update from him soon.
Oh, excellent. We look forward to that. Yeah, emerging markets is part of the world that we like because of valuations, and within within foreign and emerging markets, India is not really an emerging market, but certainly as part of the kind of the BRICS group, India has been a huge outperformer, and it's in our portfolio, and we keep looking at the charts and wonder when it's going to turn, because with our technical discipline, we will hedge with covered call options, and we do have India hedged with covered call options, but we'll let that asset continue. We'll let the trend continue until it ends, and India has been extremely strong. We have rotated out of Latin America in the last few months. There's been some noted weakness in Brazil and Mexico. Mexico has a new president, their first female president. There was a lot of questions about that, not the fact that she's the first female president, but questions about the politics there caused that to sell off. So we rotated out of that, but we're in Japan, India, and a few other places as well. And in terms of sectors, we're constantly looking for the highest relative strength sectors. I mentioned earlier, or if I didn't, I usually mention every week that we're about 40% equities. And within those equities, we're picking some of the strongest sectors. I just mentioned some of the emerging markets and international. That's around 14% or so. The rest is in the strongest sectors. And just taking a look at our sectors right now, surprising how strong some of these have been. Utilities has been a star performer.
Mhm.
Utilities has been extremely strong. Industrials is in there. Telecom has been shockingly strong. Healthcare and software. And even though technology has been a little bit weak relative to the rest of the market in the last month or so, software has hung in there. We actually took a stop on semiconductors about a month ago, but if we're right about this stock market potentially having a little more legs in the next month or two, it would be hard to believe that semiconductors wouldn't bounce as well. But so we're doing well this year. Our accounts are doing well. Our model is doing well, even with only about 40% equities. We do have about 10% gold mining stocks in addition to that. So if you count gold mining stocks, we're more like 50% equities, but we still have a big chunk of cash. We've got some long-term bonds in the form of TLT and similar exchange traded funds. And so we never want to get too comfortable, but so far this year has been good.
Good. All right. So bonds, let's talk real quickly about last week's 50 basis point Federal Reserve interest rate cut, which now is the monetary policy pivot, right? They're no longer hiking. They're no longer not cutting. They are now actively cutting with a strong inclination that they're going to continue to do more. Obviously, I presume that didn't hurt your TLT position there. But what implications are you looking for coming out of this now confirmed policy reversal?
It was really interesting that whole rate cut. That was the most anticipated rate cut in history, and the market was very much waffling on whether they thought it was going to be a quarter point or half point cut. And by the time we got to within a couple days of the meeting last Monday or so, we were close to like an 80% probability of a half a point cut, and that's what we got, a half a point cut. So it was the first rate cut in quite a while. I don't remember the exact number. I think it might have been 4 years, actually, if I remember correctly. It was a long time. And it was a pretty big rate cut. It was pretty much expected. And so the market, it was interesting. Taking a look at the stock market, the S&P first spiked and then went down, and it erased the whole thing. So there was a sell the news reaction. A lot of people said, well, hey, that's not really surprising. Everyone knew there was going to be a rate cut, and Wall Street often sells the news. But what I've noticed in recent years is you really can't, there's no one cliche that you can count on. And so I was thinking to myself, well, maybe tomorrow the market will fade the fade. And that's exactly what happened. So the market faded the news and the market went down. And then the next day we were going, gangbusters up 100 points on the S&P. So I don't know if you had something to add there, Adam.
No, just wanted to make sure if you guys thought that there was some sort of, material implication that might impact your future allocations that we put on the table here.
No, so the market had a strong reaction afterwards, both in the S&P 500 and in gold, silver, and in mining stocks. So no, there's nothing that happened in that rate cut decision that changed our mind. Ultimately, we think that rates are going much lower. We think that the Fed and other central banks are going to have to maybe even panic as the cycle finishes. Valuations are just that extreme. The valuations are higher than they've ever been before. And I guess that makes sense because the stock market is as high as it's ever been before. But the stock market price doesn't measure valuations. We've shown other data, and we could show anytime, in the future on this program, actual data, but valuations are not supportive of positive returns going forward. And I think that the market's very complacent. And I think that we're nearing the end of this cycle. We'll see. And maybe Lakshman will come back on and say that he's seeing some indicators turn. But so it's a difficult thing because an investor or a money manager is forced to play the game. And we're still long in this scenario. We're still 40% stocks, 50% if you count gold mining stocks. And thankfully, gold and silver have broken out like we expect them to. And mining stocks are starting to catch up. And so that's helping us out quite a bit. But no, nothing in that 50 basis point rate cut changed our mind. In fact, I think it's probably the fuel that might plant the seeds for this maybe euphoric exclamation mark that we might see to end this rally as we know it, or at least for a bunch of years. So I'm not seeing any real FOMO or any euphoric sentiment in the market. Some of the surveys seem to be getting a little bit overly bullish, like investment managers survey and the like, but in the public and the people we're talking to, we're not seeing euphoria yet. And maybe that's what we have to see before we see an actual turn. And that could happen in the next couple of quarters. In fact, I think it will likely happen in the next couple of quarters. It should be supportive of stocks in general for a little bit longer, should be supportive of gold and silver as well. I want to be careful to say, though, that you shouldn't trade or make investments based on that viewpoint unless you're very, very swift and know how to act quickly and you know how to hedge with options, which is what we're doing.
All right. Well, look, on the day that we're talking here, gold is at 1685. 2685 at the time we're talking. Silver is over $32 an ounce. Again, Mike, I want to give you continued credit that coming into this year, you pretty much every week show the charts of gold and silver, and you were showing these technical patterns, these wedges that you were saying look like there could be a breakout. You gave your price targets. I think we've hit and probably exceeded a number of the price targets that you mentioned, at least for gold. But at near $2,700 gold, $3,000 an ounce gold doesn't seem so crazy anymore. And I know that you have brought that up in the past when you've been showing the charts and you're like, yeah, I think we could get to 2,500. And then if we get some more excitement, it could get up to 3,000, which, when gold was in the low 2,000s, still seemed like a kind of a bold call, but now it doesn't so much anymore. Do you think we're going to see sort of a tractor beam start pulling gold to 3,000 an ounce, given that it's now beginning to get an achievable distance of it?
Absolutely. I think that's pretty likely. Let me just show these charts for the folks that haven't seen them yet. And for the ones that have, here's an update. And I'm using the ETFs because this chart package doesn't have futures, but the chart, the shape of the chart is the same. So gold is right around 2650. Take a look at this monthly chart. We've been talking about this chart for years. I think it's the largest cup and handle I've ever seen in any asset. When we broke out the beginning of the year, it was a pretty big move. And even then, it was possible that we could have backed and filled this thing and had some sideways move, but we didn't. It's just been straight up since then. We were thinking that 2,500 was a magnet. And that's right around where this red line is. And since then, it's kind of gone right through there. So we're at 2675, like you just said. Now, could we go to 3,000? We could, absolutely, quickly. But I can no longer say that gold is undervalued and that it's going to have this pop, because it did have the pop, right? So there it is. And so I think that gold will reach 3,000, maybe even a little bit more, but I am not sure anymore. I guess I could say I was never sure with 100% certainty about anything, but I believe that the odds of a pullback are definitely increasing. And so you've got to be careful. If you have felt like you were overweight metals for a long time, like a lot of our clients were, this is the time to start dollar cost averaging out. This is not the time to start piling in more if you already have a position. I will say, if you don't have a position already, you should do 5 to 10% of your investable assets in gold and silver. But I'd probably start with closer to 5 and maybe even buy it in pieces. So here we are at close to 2,700. It will probably go a little higher, but this is the new range. This is what you need to now think, is that 2,500 to 3,000 is the new range, right? Back when it was at 2,000, it was easy to say, the charts say we're likely to pop there, because it was, again, nothing's guaranteed, but the charts were pretty darn bullish and, very much leaning in that direction of a pop. Let's take a look at.
But before you move on, and
Mhm.
we got to wrap up here relatively quickly, so I'm going to speak fast. But Mike,
Okay.
if I had shown you this chart at the beginning of 2024, right, and said, Mike, this is what gold's going to do for the rest of the year. Up here where gold now is, closing in on 2,700 an ounce. And by the way, I'm citing futures prices, not spot prices.
Mhm.
Where would you have thought silver would have been at this point?
I
Like,
would
if
have
gold's
thought
gonna
that
go there,
silver, and this is what's puzzling to me, and I think silver's got an even bigger move coming than we've already seen. I would have thought that silver would be 40 to 50, 40 to 50. Now remember that silver is more violent than gold and has more parabolic moves than gold. For instance, back in 2011, silver went to 50. It went from like 15 to 50. It tripled, whereas gold, was up maybe 40 to 60%. So silver tends to exaggerate in both directions. I would have thought that it would be back near its old highs. Maybe not, much higher than its old highs, but I would think that it would be approaching its old highs, and it really isn't yet. So take a look at an ETF for silver on a monthly chart. It's equally bullish, but instead of that big flat base that you saw on gold, you have this big triangle here as the price is constricted. And this was really maddening for anybody in silver all these years. And we were saying here on this program that this triangle is constricting, it's reaching an apex, watch for breakout. So gold had its breakout. Interestingly, silver lagged by about a month or so. Gold broke out a little bit earlier, but then finally silver followed through, sorry. And then silver went up to like 32 and went back to 24, which was a huge pullback, 25 maybe. And so this is a monthly chart to kind of take the emotion out of things and sit back and look at the big picture. Well, look at the last 4 months and how annoying that was for people. Even just looking at this ETF, it went from 30 to 24, and went back and forth in that range. And then just this week, boom, here we go. We're right back up to the old high at 30. I drew this line up here at 32, which is where I think this is going in short order. Even if gold doesn't go higher, I think that this ETF is coming up at 32, and that would be equivalent to about 34 to 35 spot silver. So, we'd probably be up here somewhere, but still, it's way below its old high, Adam. Is it going to get there to its old high? I think so, but I wouldn't count on that anytime in the very near future. But I do think with pretty high conviction, I can say I expect it to go to 34 or 35 spot silver.
okay. All right. Well, look, we're going to have to wrap it up there. Obviously, those charts beg the question, what's going to happen with miners? I want to be able to give you more time to actually talk about that fully, Mike. So we'll earmark that for next week.
Okay.
So folks, in wrapping up here, if you enjoy the conversation with Lakshman, would like to see him come back on this channel, especially if his forward indicators start telling him a different story, please let us know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. If you would like help in implementing any changes in your portfolio based upon what you heard from either Lakshman or Mike today, highly recommend that most people watching this do so under the guidance of a good professional financial advisor who takes into account all the macro issues that we've discussed. If you've already got a good one doing that for you, great, stick with them. But if you don't, or you'd like a second opinion at least from one who does, then consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money, maybe even Mike and his team there at New Harbor Financial. To do that, just go to thoughtfulmoney.com, fill out the short form there, and the advisors will be in touch with you pretty much immediately. And a reminder, these consultations totally free. There's no commitment to work with these guys. It's just a free public service they offer to help as many people as they can. Lastly, the early bird price discount for the upcoming Thoughtful Money online conference on Saturday, October 19th, expires at midnight this Sunday. So I think this video is coming out on Thursday. So if you're watching this in the next couple of days, you only have just a little bit of time to lock in that lowest ticket price, and I want you to be able to get it. So if you haven't yet registered, do so now. Go over to thoughtfulmoney.com/conference. And a reminder that if you are a premium subscriber to our Substack, you get an additional $50 off of that price. Mike, thanks so much for joining me for yet another week. Look forward to seeing you next week. And again, we'll do a deeper dive there on the miners. Everybody else, thanks so much for watching.
Thank you, Adam. Always love being here. See you next week.